Investing Network as its president and has helped to incubate a UK crowd investing platform as a CEO. And just to add, I also call him futurist. I don't know if he calls himself the same, but I believe that because we had a couple of interactions in the past, and I do see him as a futuristic talk in terms of his vision, in terms of creating an ecosystem for startup innovations, and he would be doing a great presentation today. This is not a conference kind of setup. It's a masterclass. So we would have questions. Yes, if time permits, I'll ask certain questions to sir, and we would like to explore your questions. So please use the chat box. The chat box is live here. If it disturbs to sir, just make sure you give a co-host right for sir, so that the chat is not a disturbance for him. But yes, you can type your own questions here. This is about learning. I would like to see most of the questions in those the topic which we're going to talk in details. And if you want to change your name with the company name which you are serving for, it would be great. Name and the company name. If you could rename yourself, you can just check the there's an option where you can rename your yourself. And if relevant, I could also see we have invited some young innovators. If you could like to add your age, because there are certain age group of leads also joining who would like to start their own great idea and explore fundraising. So if that's the case, please do mention your age if you do not have a company name there. And please do ask all relevant questions. I'm seeing all of them. And we are at Masterclass to learn specific from our master today. Let's make it good one. If you have any difficulty in joining the Zoom, we are also live on YouTube. There is a link which would be highlighted in the chat box. In case if you feel difficult in terms of logging on Zoom, you can watch it live on YouTube as well. And I would say sit back and get ready to welcome our master today. Sir, this is your class, and हम आपके students हैं आज के दिन. I'm also would like to learn a lot from you in terms of art of fundraising. Please unlock this art of fundraising masterclass and do share your screen, sir. Welcome you, sir.
Sure. Thank you so much, Gavin, for the awesome introduction. I must assure you that in every single session I have done, I have learned as much as I've imparted. So I'm equally looking forward to this session. Just tell me if my screen has come up on the screen for you guys.
Yes, sir. It could be visible.
Right. So let's kickstart the session. I believe we have 45 minutes for this presentation, and then we are going to get into a small discussion, Q&A with Gavin, and of course, then throw the floor open. So without further ado, let me jump into the session. First, let me quickly introduce myself. Like, who are we? What is the Great Unicorn Hunt? We are a community of 1,600 plus, 300 founders. All the stats are here for you to consume in terms of what we are building at www.thegreatunicornhunt.com. We have been responsible in a short span of 6 months in terms of launching India's first startup knowledge series on radio. We started the first kids startup forum. We are the first company in India to have Dave Burkus as a mentor, and we also piloted India's first deep research inquisitive lab for data science research. You are going to hear this name Dave Burkus quite a lot. Just to give you the context, when most VCs in India would regard 25% or 35% IRR as an awesome accomplishment, Dave has an IRR of 106% to his accomplishment. He's the chairman emeritus of Tech Coast Angels. And for us to have somebody like Dave mentoring us is awesome. We did some virtual sessions with him. We had invited him to do some virtual sessions for us. I'm also going to play some clips from those sessions for you, just so that you get a fairly good idea of what the biggies are thinking about this. At this stage, I'm going to give you a sneak preview of the India's first startup knowledge series. Just tell me if you can hear this.
So the audio is not enabled, sir.
Audio is not audible?
Yeah.
1 sec. Okay, so I think when I share the screen,
The blue box, I guess.
I think I need to
The
do the share
checkbox.
sound. Yes.
Yeah.
Yeah. Hopefully I should be good now. Let's see if I can do it now and if you can hear it.
Yes, sir. You can.
Thank you. This was basically to make sure that since this is an afternoon session, an opportunity to make sure we are all awake, but also to kind of, demonstrate what kind of questions are we posing. And I'm sure what we are going to do in the next 45 minutes will touch upon some of these aspects. So that was the, quick context. Among other things, here's something we have done with our About the Line, making sure that we have been displayed in SpiceJet, in AC buses in Bangalore, and in our famous double-decker buses in Mumbai, just to give you a flavor in case you're likely to see this brand somewhere. So here is what we are going to do, a quick foundation and context setting. Like I mentioned, we are going to talk about Dave and what is his take on various aspects that we are going to discuss. The pitch deck and pitching discussions, we are also going to watch a small founder interview clip just for active listening, and something that could be dear to heart for most listeners, which is the trends or the crystal ball gazing, like where is the new opportunity going to be for most angel investors, for most founders. So this is a quick nutshell. We have a really, really power-packed afternoon, so bear with me if I'm, perhaps rushing through some of the slides or, perhaps not able to spend enough time. Here's quick look at angel investors, VCs, family offices, the people you are going to deal with as founders, because you would always want to know what would be their motivations when it comes to investing money in your proposition. So obviously we know this is perhaps saying the obvious, but they invest money and they also invest time. And the reason the second point is mentioned in so many words is sometimes founders do the mistake of presuming that the investor should just basically cut a check and then forget that I exist, leave it to me to make it successful, which is not necessarily how many investors like to approach it. They really take an interest in the business, in the founder, in the progress, and all of that. So what do they bring to the table? Overall acumen, mentoring and coaching, serving on boards, and of course, overcoming networking challenges. Now, why this slide is relevant, largely from a founder's perspective, I believe, is that when you are deciding which kind of investors to go after, you might want to look at who brings the most to the table as far as your business is concerned. Do you need somebody from the industry, an industry stalwart, to kind of guide you? Do you want somebody to represent you on the board when you go for future rounds and you need a heavyweight? So what they bring to the table is very relevant when it comes to you choosing what kind of investors you would like to go after. And it's almost like an inventory checklist in terms of which VCs or angel investors you would be chasing. I sometimes hear from founders that, hey, you know what, can founders really afford to be choosy? I mean, we are in the middle of a fundraise. We basically want to make sure that whoever is willing to invest, we are willing to take from them, which is fine, if you are spreading your proposition wide. But what we have observed most of the time, that if you want to make your fundraising process as less frustrating as possible, don't just chase the big numbers and just trying to pitch to as many people. You need to do that. I'm not saying you discount that and just keep talking to 5 people. That's not what I'm suggesting. But what I'm suggesting is that when you look at people who are relevant for your proposition, the likelihood of your fundraise processing becoming more effective, fundraise process becoming more effective, less frustrating, and very productive is that much higher. So of course, we know what they bring to the table, who are they, what they do. This is largely what you already know. They're domain experts. If they're angels, they would invest 3 to 12% of their net worth. Or if they're VCs, they would deploy the funds and obviously participate in separate events. So of course, why do they become angel investors or VCs or CIOs of family offices? And it is important to understand, especially when you are pitching, what is really the motivation of the guy sitting on the other side of the table. Is he passionate about your business? There are some people I know who have spent 5, 10, 15 years in a particular domain. So when they come across a startup from that domain, they're that much more passionate, that much more aware of the nuances and the pitfalls. So obviously you might want to make sure what kind of person are you dealing with? What are his motivations or what are her motivations in talking to you? And like I said earlier, the better handle you have on who you are speaking with, who you are pitching to, more likely is the process going to be pleasant for you. And of course, some of these slides are placement slides just to draw the difference. We know that a VC is usually investing somebody else's money and has a huge amount of accountability and answerability to that. An angel investor is in most cases investing his money or the family's money, and is practically the solo decision maker in most cases. Something that you're very familiar with, the various stages, in a founder's journey. First comes the personal savings, a little bit of friends and families, and angel investors, and of course Series A and IPO, and all of that. There is one thing I wanted to draw out from this second box, the friends and family. And I've seen sometimes founders take undue advantage of the comfort they have with their friends and families. And what I mean by that is, it is sometimes observed that founders tend to slide in a substantially higher valuation than what a professional investor would have given them, thinking that the friend is not going to mind, the family is not going to ask me. Perhaps they're not even aware of the nuances of what valuation you should command or demand. And they know you, they trust you, and they believe that, hey, you know what, if he says that his business is valued at 30 crores, no harm, let me just trust my capital with him. There are also some extreme cases where just because it's from friends and family, equity is practically doled out in almost a hemorrhaging fashion, which is also not such a good idea. But let me talk about the dangers of higher valuation. You might, as a founder, believe that you have got away with a larger valuation, but what happens is two things. Number one, if with the capital that you have taken from friends and families, if your point A to point B transition is not that great, and if the professional investors, VCs, are not willing to give you that kind of valuation, two very peculiar scenarios emerge in front of founders. One is, do I refuse the offer and say, look, sorry, I raised the last round at 30 crores. If you're not giving me 45 or 50 or whatever that number is, I'm not taking from you. Or do I do a down round? Hence, my suggestion is, instead of reaching the point where you have to retract your steps, better to be transparent with friends and families, better to be realistic in terms of the valuation number you present, so that you are not going back and forth. This is a word of advice I would offer at this stage, especially if you're raising money from friends and families. Let me quickly talk about the 10 filters that investors tend to apply. And it would also be very useful for you to keep in mind what you should kind of deploy in your pitch deck, or how you would like to fortify your pitch deck when it comes to defending the 10 filters that investors are likely to apply. So one, of course, is the BG, the background check. As much as you would like it or not, investors are really interested in knowing about your education, your pedigree, the organization you have worked for in the past, if you have worked somewhere else, or the acads or the college. Now, mind you, that doesn't mean that there is necessarily a bias towards a particular thing, be it a particular university or a particular years of experience. It's not as if there is necessarily a bias. What this tries to convey as a filter is, they're just trying to make sure that whatever you have conveyed as a part of your background tallies with their investigation as well. The second most important one is whether you're solving a real problem. Just this morning, we were doing a kids startup forum where I was kind of going deep into explaining each term. I'm presuming I don't have to do that here, but solving a real problem is the key. Investors will see through that if you have built up an imaginary problem. And needless to say, a real problem will always accompany parameters that you would want to include in terms of validation, traction, number of paying customers, recurring customers, all of that. Third point, addressing a large market, because no investor wants to get into a cubbyhole where the only thing you could grow is maybe 10% or 30% growth. Nobody wants that. Even 100% is not acceptable. So are you really addressing a large market? And I don't want to get too granular at this stage, but the TAM and the SAM that you are doing as a part of your working assumes huge importance. And please don't take this part lightly. That would be my word of advice for you. I know of a startup, awesome team, had built a very significant top line, been in existence for 2 years, had managed to secure, with our help, FaceTime with one of the largest VCs in the world and in India, of course. And there were 3 or 4 meetings, everything went well. And at one point of time, the talks broke down simply because the team at the VC's end was unable to compute, unable to comprehend how had these guys arrived at defining their market, what were the assumptions, the underlying assumptions under the TAM and the SAM. So even if it takes a little longer at this stage, at an early stage, in terms of really defining your market, that's absolutely fine. But try and get it right as much as you can. I'm going to maybe jump, if it is fine with everybody, straight to point number 9, the competition, direct or indirect, because many cases we have seen that founders either tend to describe competition as non-existent, thinking that it will win the investors' vote, saying, oh, wow, there's nobody here. Now, if that's genuinely the case, you should say that. We are not saying that even if there is no competitor, please invent one. But please try and understand the repercussions of what you are saying. Absence of competition could also mean that nobody else is finding your space attractive, which could be a good thing, which could be a bad thing. It depends on how you intend to monetize and present the fact that there is no competition in the space. The other mistake I have seen sometimes founders do is describe the competition in very narrow terms, like maybe just 2 or 3 companies, forgetting the fact that there are there's somebody else out there doing similar stuff who could eventually be a competitor. And I would say it is absolutely acceptable for founders to be very, very realistic about what kind of competition they see around them, even if it is indirect, even if it is a little on the horizon, because that gives the investors a comfort that, hey, you know what, these guys have at least thought through the whole part, thoroughly well. And of course, the barriers to filters, the investors' bias, absence, existence of global or domestic business models. You could just be in the too much of the regional space. You may not have had the adequate validations, the cohorts, the data to convince. But there will be variety of things you will encounter, and you can't afford to forget the fact that human beings are what investors are finally made of. They're human beings. They have their own biases. At this juncture, I'm going to tell you a very interesting story about Dave Burkus. You've heard this name before from me in this session. You're going to see a little bit more about Dave. But I had the good fortune of listening to him in Philadelphia, at a large conference, and he narrated this story. And in the interest of time, I'm going to compress the story. But Dave talks about a company he invested in, and literally 3 weeks after he's invested, the technology head comes to him and says, "Look, Dave, I want to quit." And Dave says, "What the hell? I just invested in your company. A lot has to be built. How can you just leave?" But this guy was very adamant. So Dave says, "Look, I kind of tried to stop him, throw clauses at him, whatever. But in 3 months, he was gone." And Dave says, "I was furious. How can this technology head just leave midway, midstream, And he says the height was that 1 week after quitting, this guy calls me up and says, "Dave, you're a serial investor. There is a small company I have joined. I would like you to invest in it." Dave says, "I banged the phone down." Remember, this is very, old story, right? You had landlines. It was easier to bang landlines. I don't think anybody would want to dare banging his cell phone down. It's just too prohibitively expensive to destroy a cell phone. But that's on a lighter note. So Dave says, "I hung up on the phone. I just kind of banged the phone down." The guy calls after 2 weeks. "Dave, just listen to me, a small story. We are planning to send books, sell books online." And Dave says, "What?" And then Dave says, "I'm the big angel investor. I know what I do, right?" So I gave him a piece of my mind and I said, "Look, books don't get sold this way. People go to Barnes and Nobles, have coffee." And so Dave shoos him off again. In fact, Dave, when he does this session, actually shares a mail where he says, "Gee, Tom, keep me posted or keep me informed," or something. And the third time this guy calls and says, "Look, Dave, you know what? It's a small company, Seattle based. It's named after a very after a very big river in South America. The last name is, the founder is Bezos." But because Dave was convinced that this is not a good fit for him, Dave transparently admits there was perhaps a certain amount of bias about the model, and he kind of shooed off the opportunity. But Dave concludes the story by saying, "Oh, I didn't lose much." I don't remember the exact number. I think he says something like, "I lost 4,000x or something." But I would say that for angel investors, it could be a sobering moment, but also for founders. The takeaway from founders' perspective is make sure you have as much information available to potential investors, even if they're perhaps not very aware of your domain. We'll talk about active portfolio management briefly, but this usually starts once you have taken the money. But the reason I'm mentioning it here is founders think that it is not such an important part of their responsibilities, whereas it is. One is, of course, to retain the goodwill from the investors who place their faith and capital in you. But most importantly, when you go for the next round, you're going to need all those investors on your side. So active portfolio management, obviously extremely crucial, extremely key. Expectations as an investor, which you as founders need to be aware of, is they are looking for investable ventures. They are continuously applying the angel investing filters, and they are assessing the new information with limited information. They're assessing new ventures with limited information. This is the operative word here, limited information. So as much as the founders can do to volunteer and fill up the gaps in comprehension, without, of course, revealing your secret sauce, is welcome. Do not presume that investors know everything about your domain. Most of the time, they may not. So they lean on you to educate them about the proposition. And it's perfectly all right to educate them. It's perfectly all right to tell them, what the landscape and the domain is all about, what excites you, what are the upsides. because in doing so, you might perhaps end up exciting the investor to your cause, right? This next slide, what could go wrong, is extremely important, because first we had this answer on the slide that said everything, everything could go wrong, but obviously that's too generic. So we kind of modified. Now, why is this slide so relevant for founders? Is because the boxes in this have to kind of surface in your presentation, literally by making sure that you're checking off and addressing some of these areas that could be bothering the investor. Technology obsolescence, how do you intend to stay ahead? Founder dispute or difference of opinion, you may not perhaps be aware, but something as high as 12 to 15% of startups flounder because of founder meltdown. That, after 3 months or 30 months or whatever that number is, the founders just couldn't see eye to each other, right? Now, what is a good mitigant here is if you say that as founders and co-founders, you have worked with each other before in some organization, or maybe went to school or college together, will certainly give a comfort to many investors in terms of what you are doing to prevent a possible stalemate down the line. Of course, regulatory change and running out of funds and lack of organization structure. I have seen usually that if founders have answers, subtle messages, important inputs in the pitch deck that address each of these points, the likelihood of the investor having serious concerns is less. And I'll come to this point out of run out of funds and raise less, spend fast. Most of the time, the investor is not just worried about whether you are a good bet or not. The last thing he wants is that you are a good bet, you are a good team and all of that, but you just don't have the capacity or the ability to raise further rounds. And you are going to be permanently dependent on the same set of investors to raise next round. And it's not as if you can hold the investors to ransom. Oh, you invested 2 crores in my business. Very good. Congratulations. Now the business is floundering. If you don't give us another 2 crores, your business is going to go down the drain. Your money is going to go down the drain along with it. So you better help us. Never works. Never works. So you'll have to make sure that the way you use your money, the way you deploy your capital, needs to be in a way that generates and instills enough confidence in the investors. Long back, before I got into this space, I decided to study what mentoring is all about. And there's this famous book, that's written by Al Ries called Lean Startups. There's an organization in the US that has actually borrowed from that philosophy and created a lean startup methodology course. And I'm a certified mentor. And as you know, the Americans have a great knack of converting common sense into curriculum. So there is a very small but important lesson they have hidden in one of those exercises, that if you have $100, don't do 2 mistakes of $50 each. You could perhaps make 50 mistakes of $2 each. So every mistake that you do eventually teaches you what is the thing you should not be doing or what you should be doing more of in the days to come. But I would recommend to all founders who are going to bake this inside your pitch decks, that having this reference point at the back of your mind as to what could go wrong is important. I'm not trying to say that you should go with a very fatalistic approach and lay out all the doomsday warning of what could go wrong in your startup. Finally, you're not in a confession booth, that you have to kind of lay down all the things that are going to, sort of go wrong. But the idea, the expectation investors will have from you is this founder aware of the risks? Has he or she taken adequate measures to kind of mitigate or eliminate the risks? That is the key question. Let's come to the part where we talk of valuation drivers. Obviously, the uniqueness of product, the offering, the business model, proven versus unproven, is an important factor. So is the robustness of MVP, revenues, upsides, exit prognosis. And I would recommend that if you are doing a solo presentation where you're not going to a particular angel investors, it is good to perhaps Google Dave Burkus method of valuation, where he actually gives you 5 or 7 or 10 blocks and expects you to arrive at the valuation on a self-assessment mode. Good founders, okay, chalo, $100,000 assign karte hain. Something else, $300,000. And then you juxtapose that information with the other deals that have happened in the ecosystem. So you look at a lot of similar deals and say, look, am I underselling myself or overselling myself? And what is it so different about that deal that is making them go away with certain valuation? As you know, there are plenty of publications in the startup ecosystem in India. There's Startup News and there's Indian Startup News and VC Circle and Your Story. And there's so many of them from where you can garner information about deals. And of course, construct your own library or reference points in terms of what to arrive at as valuation. But in spite of whatever you do, it's quite likely that you may still have a valuation mismatch. And the best way to tackle that is through alternative opportunities, tranches and milestones, clawback. And I'm just going to spend time quickly on these 3 parts: tranches and milestones, clawback, and valuation. So obviously you might be okay as a founder saying, look, you don't want to put the entire money now, do that in 2 parts, 2 tranches, and after a certain milestone, which is just the innocent part of it. And milestone could be time-based or revenue-based or some metric-based. But the clawback is a little dangerous territory, where you are saying, look, I will get to a certain revenue number in, say, whatever, 6 months, 9 months, 1 year. If I'm successful at what I'm doing, you will give me a higher valuation. If not, I will slip back or I will stay on the valuation you have given me. And in many cases, investors are absolutely fine with that kind of an approach, saying that, okay, the clawback is an acceptable clause. But as founders, you need to have the courage of conviction to go in for a clawback clause. Valuation floor and cap, very obvious. You'll have to decide a number above which valuation cannot cross. You have to decide a floor below which a valuation would not be acceptable to you and things like that. So now we come to an interesting part, which is Dave Burkus and his stake. So like I said, we had invited him and done sessions with him. And that's how we had kind of garnered a few things he looks for in the session. So at this stage, with everybody's permission, I'm going to play a clip, which might give you 20 second answers on what Dave looks at. Just let's listen to Dave.
It is very typical that the company, when it runs out of cash, whether scheduled or not, will ask the angels one more time for another round. I led an angel round of $6 million, which was a very large round. And we brought in 32 million worth of additional investment in that company from the VCs, well-known VCs. I have never seen a case where the angels came in to rescue a company after the VCs. That unlike a public company, the founders look for the money and then act independently. The good ones, of course, act as if they have their investors included in their shareholder board meetings and in many cases in their process of making decisions. That's rare. And a quarter of my founders or CEOs report well every quarter, as they're required to do by our documents. 3/4 of them ignore us. And we hear from them when they need money, because the VCs have more to lose because their investment was much larger. I have examples and I can tell stories, but we don't have enough time. But just here's a 10-second story. The company failed. And the story about the failure is a little longer than this, but the angels did not participate in those later rounds. And depending upon the lead angels, it will be a round that is beneficial to the angels, priced correctly, or punishment to the angels, which is a down round or a pay to play. The valuations were too high and the amounts were too great, and the VCs didn't care. They didn't want to dilute the cap table with a large number or an increasingly large number of angel investors. It is not normal for a good, especially professional angel investor to abandon a company.
So you heard what Dave said in terms of his take. These were very small clips, but I just kind of presented them to give you a perspective of Dave's thinking. And some of the questions Dave certainly was very keen to kind of table during the sessions is, as a founder, do you know who is going to buy your business? What is the price that the buyer is going to be willing to pay? What investment will you need as founders to reach that point? Does the Dave Workers valuation method apply? And most importantly, do benefits outweigh the risks? Because please try and understand, there is this whole chemistry about the founder's passion, about his competence, about his or her ability to create a great business. But unfortunately or fortunately, the reality is that the investors will like to hear all of that, but will want to back only those startups that have a fairly good shot at giving them high ROIs, right? So if your pitches, if your thought process, if your presentation, if your business model is aligned in that direction, that's going to be a sure shot winner. And then, of course, we talk of expectations, the term sheet, the valuation mismatch, and all of that that's going to be important. These are the key terms I thought you might want to Google up or look at in terms of valuation, the investment instrument of choice. And one thing I can tell you, the terms here have been chosen in a way that if you take care of these terms in your term sheet or your SHA in a manner that is favorable or at least not detrimental to you, you are good to go. I'm just going to spend time on one that always jumps out, the tag along and the drag along. And most of you must have Googled or heard about it. But let me just quickly describe. A tag along is when you are the lighter party and you are just attaching yourself to a bigger deal. That is the tag along. And the drag along is when you are the heavier party and you want to kind of drag somebody else. We are going to, if time permits, spend some time on very, very dense term sheet clauses as well. Just so that we get a flavor. The idea is not to make this a legal session, but finally it's a masterclass on fundraising. And if you were to ignore some of these critical points to negotiate on, you could really regret it later. So obviously tranches and milestones, we spoke about that, the board composition, valuation and clawback, we spoke about, and the dilutions, future rounds and exit avenues are absolutely critical points for you to negotiate on. I'm going to give you 10 seconds to just read the first part of the sentence till the word overseas markets is there. Can I just give you 10 seconds? The investor and the company agree that the sum of some placeholder amount will be utilized toward design of blah, 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 to execute the pilots, secure some approvals for overseas markets. Do you think there's anything wrong as founders in this sentence? I'm presuming it's a no. And any increase in the future, founder's salary will have to be subject to board approval. I won't, go too deep because it's fairly self-explanatory. But try and look at the English here. When you say that you agree that the sum of rupees so and so will be utilized towards blah, 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 make sure that it goes towards blah, blah, blah. Tomorrow, you cannot come back and say, look, design for manufacturing, I'm the manufacturing director, so I had put myself a certain amount of salary, so hence 1.5 crore make a 40 lakh to mere salary mein chalega. That's bullshitting then investors. Doesn't work, never works. So your usage of funds, I repeat, is an extremely strong weapon in your hands to secure the investor's confidence. Most people think usage of funds, haan, term sheet mein SHA mein dal denge. That is exactly what the investor wants to know. Okay, if I put 1.5 CR or 2 CR or 40 CR, whatever that amount is, how are these guys going to use that money to go from point A to point B? Because, and let me give you some examples. If a chunk of your investment is in marketing, and that too the volatile kind of marketing where you are burning a lot of money on Google and Facebook, if your business demands that, people will understand that, okay, fine, he has no choice, he has to do that as a founder. But the investor is also going to worry, what happens after this money is over? maybe as long as my money is with him, Diwali hote rahegi. The moment the money gets over, these guys are going to suddenly drop back in terms of the revenues. Usage of funds, extremely critical, guys. I would never recommend that you underestimate this part in your contracts. Liquidation preference, liq pref as it's called. I would recommend you just read the last part, non-participatory nature. In the event of any liquidation event, the amount payable to the investors will be 1x. And this is basically to insulate the investors. If you have a way to fight this, please do that. If you don't have a way to fight it, it's okay. It's considered a fairly standard clause. But obviously make sure a good legal guy or an outsourced legal team has a look at it. Tag along. If at any time after the lock-in period, any of the founders wish to dispose of their shares, the investors, inter alia is not alia, but it is about, among other things. Exercise a pro rata tag along. Within a period, the investors shall have the right to demand that the founders procure the transferee. What is this blah, blah, blah English saying? Mr. Founder, if you are selling your shares, bhaiya, mera share bhi bechne ka intezam karke de. Is simple thing that this clause is telling. And again, fairly normal clause. They don't want the founders to suddenly scoot or get some sweet deal on the sidelines, private deal that leaves the investors in the lurch. Fairly normal clause. Drag along clause. This, as founders, is a loaded clause. I'm going to give you 10 seconds to just read this clause and tell me what this clause means to you. Okay, in the paucity of time, let me explain what this clause means. This clause was not written by a legal guy. This clause was written by a script writer of Hindi movies. You know why I'm saying this? Because this clause means that somebody can come into your company after 7 years, revolve your chair, your reclining chair, and say, "Aaj se ye company hamari, ha 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 ha, Balwant Rai," or whatever they say in Hindi movies. Look at the English here. We'll have the right to sell, merge, liquidate the company at its own options. Matlab, basically it says that if you're not able to deliver this IRR, whatever, and it's not about whether it is 20% there or 35%. In principle, he's expecting you to guarantee a return in a finite period of time, which as founders, you're not supposed to do, right? You are supposed to make sure that why 25, you should be giving him a 95% IRR. But you can't be handing over a loaded gun to the investor with all the bullets loaded and then say, "Sir, jab bhi marji aayega, trigger daba dena. Main to yahi baitha hu." Right? That's something you just cannot afford to do. Not now, not ever. Right? Now we come to some of these pitch deck discussions, which is a very important part. Ye to sab theek hai. This will keep at the back of the mind. But what do we put in front of the investors? That's where the pitch deck comes out. If you do a Google, you will see tons of write-ups on the opening, problem, your solution. This is something we recommend should certainly be a part of every pitch deck. The opening, obviously your tagline or whatever, the problem statement, your solution. Because finally what the investor wants to know is, what are you doing? What exactly do you do? Right? Then of course the business model, competition, team. Now to build these 12 slides, in the next 5 minutes, we are just going to go through the ingredients of what need to go into this 12 slides. So let's look at steps in terms of becoming fundraise ready. Obviously, we are going to cover the angel investing part, the business model elements, filters, all of that, right? And this is largely for angels, but obviously it's not as if it is not applicable to VCs, because obviously the game changes, the language changes a bit, but the essentials will not change. We looked at the 10 initial filters. Make sure that your pitch deck certainly has these 10 filters. Cannot afford to go around with these 10 filters. Second, what could go wrong? Make sure that your 12 slides have in some way addressed each of these factors that could threaten an investor's decision in your favor, right? And setting the context. Have you included the pain point and how real is it? The value proposition, how sharp is it? What exactly do you do? I've seen some presentations where the founder does a brilliant job of presenting and the investor is also very happy, smiles, puts one leg over the other leg and says, very nice presentation, Mr. Founder. So what exactly do you do? And that's like, boss, this is a complete washout of a presentation because the guy just didn't understand what the founder was doing. Founders sometimes have the disadvantage of an extremely high proximity to their own business. So they forget the fact that investors may not necessarily be clued in to their business. And hence we recommend go slow, make it a point to explain what you are doing. And the ultimate objective is obviously to educate the investors so that he feels sufficiently excited about having the next meeting with you. Now, I will kind of run through some of these slides, because when somebody says pain point, what does it mean? The questions you have to ask is, was the universe size used for your study? If you say, oh, I just consulted 5 patients, not enough. If you say, oh, out of 5, 2 said yes, not enough. Now, this will differ from industry to industry, startup to startup. So I have avoided putting numbers here, but you know, you're not bullshitting anybody. You know instinctively what's the right business metric that you need to follow. So the pain point qualification, extremely critical. Do not embark on your pitch deck or investor meetings if you're not been able to sharpen the pain point or validate the pain point. Next is value proposition. Some questions you might want to ask yourself. If you didn't exist, would your customers have no other option? Can you command a premium for your offering? And how many rats have you killed? Now, rats is not the rats that we know of as animals. RAT is an acronym that has been constructed for riskiest assumption test. Let me give you an example. Suppose your startup is in a baby care business. What is the riskiest assumption, the topmost assumption, the black swan event that can put your startup out of business? What do you think is it for a baby care business or a baby product business? Exaggerated, but हो गया तो खलास, दूसरे दिन से धंधा नहीं रहेगा. Let me volunteer. If hypothetically babies stop getting born, right? I know I'm exaggerating the point to make the point, but that's a rat. That's the riskiest assumption, that business can come to a standstill. And for those who are under the impression that वो rat कभी होता नहीं है, serial number 1 तो impossible है, doesn't work. There were very, very good examples. For example, an events business, which completely depended on people meeting each other in physical venues and all that. And the day the lockdown was announced, next day the business evaporated. So do not be under the impression, dear Mr. or dear Miss Founder, कि वो नहीं वो serial number 1, serial number 2 तो apply नहीं होगा. Make it a point to jot. कुछ फर्क नहीं पड़ता. Jot it down for God's sake. And if it means that if there is a way to mitigate, like that events company said, yaar, agar log milna band ho gaye, then they might still do the events virtually. Let's be ready for that, right? Will certainly help you prepare for the worst, but have those rats and kill as many of them. But it is generally believed that whatever you put on your list, serial number 3, 4, 5, are the ones you'll have to deal with the most. If you have not attacked serial number 3, 4, 5 of your rats, tension hai. Aapko bhi tension hai, investor ko bhi tension hai. So keep this in mind when you're talking of value proposition. Then of course, what exactly do you do? And why is that innovation, is in the idea or the execution? You have to answer these questions. Then of course, is this the best team? And why are you a best team? All of that merits an answer. Then of course, knowing the market and competition, the TAM and SAM, and then there's room for how many players, then the traction. And I've intentionally said traction is spelled as validation because people don't care whether 5,000 or 50,000 have sold. It is out of how many. If you have a base of 50 million and only 5,000 have bought, that's not validation, that's not traction. But if you have a universe for your product or offering of 10,000, and 1,000 have bought it, oh, that's awesome. You are getting that traction to be spelled as validation, right? So that's the next part, who is buying and why. And of course, the financial hygiene. And now we'll come quickly to the business model elements. And that is the last but one segment, I think. So value proposition. And I'm going to, kind of breeze through this because some of it is obvious, but something that you have to, kind of factor in any way. Is the differentiator clearly visible or is it only visible to the founders? Customer segment, right? Do you have that clearly spelled out? You can't have a situation where you have product for a giraffe, which is being offered to the, to deer, so your customer segment has to be well defined. And there are lots of examples. In the paucity of time, I'm going to rush through this. And of course, the channels. Are the channels excited about your product offering? Is your customer relationship quantified? Do you know the CSAT? Have you been able to measure it? Saying that we are small is no excuse, right? Then are the co-founders the most important resources? Have they been bound via co-founders agreement? In many cases, we have seen that there are founders and co-founders, but never a co-founder and a founder agreement. After this meeting, if there's anything you need to do as founders, if you have incorporated a company, have a founders agreement. It is the basic document, and it is not a scary document. It just captures the understanding between the two founders. कि भैया तू छोड़ के जाने का decide किया तो your shares will come to me, or will they be sold to the investors, or at some pro rata, or the number of years. Spell it out. Because if you decide to part ways in the absence of a founders agreement, that's the end of it. You're inviting disaster and dispute in your conversation. And something, God forbid, one founder passing away, a demise. What happens to the shares? Do they pass on to the other founder? Do they go to the family? What percentage? Spell it out. No, what's the harm? So if your key resources are co-founders and all eggs are in the one basket, should not be, but irrespective of whether the eggs are in the same basket or not, better have a founders agreement ready. The key activities, the key partners, the cost structures, at least you should know the aate dal ka bhav. Then who exactly is your customer? Paisa kaun dene wala hai aur bar kaun dene wala hai? Then of course, we spoke about this usage of funds as a tool. Are you sure of this? Now that we have covered this, I'm going to play a short clip, maybe not the whole clip, it's a 3-minute clip, but I'm going to just play. If you think you are getting some of these answers from here. Now it's an interview, mind you, it's not a pitch. So obviously it will not have all the answers, but just see if it helps you form some impression. Let's jump into the rapid fire section immediately. Very, very curious to hear from you, Jeevan. What exactly is the pain point that you guys are addressing or attacking?
So it's all our own experience. Everybody needs services. You have a home to take care of. You are busy with a lot of other things. What do you do when you need an electrician or a plumber or a cleaning service or a haircut at home? Because we've just been through the pandemic with all the lockdowns and everything. So what do you do in those cases? Where do you find the right people to do something? And that's I mean, simply put, that's the pain that Jabboy is solving. But in a more wider sense, what we do is much more than that, because we connect customers with everything local. There is a lot that e-commerce companies don't cover. So we have found opportunities in a lot of places where we can connect customers to experts locally. Awesome. This is terrific. So what exactly do you do? What is Jabboy all about? What is the platform all about? Basically, what we do is connect customers with experts locally. So it could be businesses, it could be individuals, it can be an electrician, it can be a hair salon or a cleaning service. We do delivery services, we connect you with doctors. So it's all about finding the right people, right experts, validating their experience, making sure that they're the right people, and then giving customers these experts at the time that the customer needs. Very interesting. Very interesting. I was a little bit, curious about how do the customers come onto your platform, which I'm presuming they do by downloading the app, but also curious to know how the service providers or the experts, be it an electrician, be it a plumber, how do these guys, join the platform? What's your outreach format, if I may, ask you? So we for the customers, we've got the website and the mobile applications. Both are easy to use. We keep trying to make the website as easy as the mobile application. Mobile application is always easier because you don't need to sign up every time. On a website, there are multiple things that you have to do. But we treat both in the same way. So the customer should be able to use our services without downloading the mobile application, even though that's preferred, because you get more options on the mobile application. For the vendors, for the service partners, we have a team that reaches out to service partners. We also get a lot of references from our existing service partners who are happy with the way we are giving them these opportunities.
So the entire interview is, of course, slightly longish. So we will, kind of skip that and come to the last part. And this is, the part where we spoke of the trends and the crystal ball gazing and what investors are interested in the future. And we have a very simple view on this. There are no magic sectors. There are only companies and founders and teams that can create magic. You should bet on what you can afford to lose, largely a message for the investors. But here's an interesting story I wanted to narrate about Jeff Bezos. So Jeff Bezos was once asked, what do you worry about? What gives you sleepless nights? What do you think will change in the next 10 years? And you know what he answered? He said, I don't worry about what will change in the next 10 years. I will worry, or I always worry about what will not change in the next 10 years. So he says, in my business, customers will never stop expecting fastest deliveries. Customers will never stop expecting the cheapest, the lowest price for the goods or the services. Customers will always expect the maximum convenience, right? So I would rather worry about what is not going to change. And, he was asked, so what do you think will be the ultimate way? Oh, you know what? If Amazon can work on mental telepathy, that if you decide to order something, you should be able to go to the Amazon app in your mind and say, I want 2 detergent bars and I want, one Bonvita or whatever, and it should get delivered. Amazing. Look at that. If a startup founder as successful as Jeff Bezos is worrying about things that won't change, how important a lesson is it for, all of us, to kind of implement in our own scheme of things. Now, this is just the appendix. We are not going to obviously go through all the slides, but the reason I'm going to show this and the reason we created Drill is I mentioned earlier that nothing works like data. And many cases, founders make the mistake of not informing or not educating the investors. And you have to be absolutely sure that you have a lot of data when you are facing investors. In fact, the reason we came up with this acronym Drill is everybody used to say, oh, you know what, data is the new oil, data is the new oil. I said, boss, oil hai to fir drill bhi lagega na, drill karne ko. Obviously, the picture is not the most appropriate. We need the drill from the oil rig. But the point is, we created this just so that we have enough data. And then, of course, this is what we created in terms of the fintech industry. And obviously, this is available to our unicorn spotters to study each sector. But I'm just going to draw your attention to one part which caught our attention. And this is all smartphones and everything that is going on and how the wireless cost is going down. कि पहले 17 रुपए था, 21 रुपए था, अभी 9 रुपए 90 पैसे हो गया. Very good. That's the reason. Price is smartphone. All this is fine. All this is fine. STEM enrollments going on, contributing. Then a breakup of between Axis Bank, Amazon Pay, who is dominating, because we would want to know as investors कि कहाँ पे ज़्यादा lopsided है view. But the funding and all that we saw. But the best part we saw, we looked at RBI circulars. And if you see this data, between 2013 and 2015, do you see the kind of circular 600, 650, 550? Please try and understand, way before 2018, when the investing in fintech took a boom, RBI was furiously regulating the space. Look at the number of circulars. As an investor, as a founder, the takeaway is, boss, agar apna field mein regulator active ho gaya, so there is certainly going to be a lot of action. And then we of course went deep and looked at the departments and all of that. And again, like I said, I'm not going to take you through everything, but similar exercise we did for the urban services marketplace and all of that, just to make sure that migrants kahan ho raha hai, is it right? The only takeaway I would have from this is that as founders, you need to know your data. You absolutely need to know your data, and there is no substitute for that. With a very minor spillage, I think we have been able to meet the deadline, in terms of the format. But that's a quick snapshot I wanted to present. Thank you so much for being such an awesome audience and for the patient hearing. Gavin, over to you.
Thank you. Thank you, sir. Thank you for the insight and it was a great masterclass. And like every class, the students do have questions. Rather me asking that questions, if rather you typing on the questions, if you can just raise your hand, I could turn on your audio as well as video And you can go live with sir asking questions. If anyone have the questions here.
And one request, if you're asking a question via the medium, please switch on your camera. I like
Yeah, please.
answering to human beings rather than screens.
So let's explore if there are any questions. If you want to ask questions, please raise your hand. And there is an option where you can raise hands in terms of the virtual setup. Let me explore certain questions here. Yeah, we have Nitin who has raised hand. Nitin, if you can turn on your audio, video as well. Let me add a spotlight here. Can we add a spotlight to Nitin? Yes, Nitin, you can ask the questions, please.
Hi, sir. I'm from robot space. We are a robotics company. We build robots, basically indoor navigation robots. So my question today is, for a company like us, it's basically hardware and software combination, right? So how do we, do a valuation of a company for a company like us? Because I mean, we are building the product, and there is no. I mean, how do you position yourself when it is a hardware plus software combination? When it's not purely SaaS or.
Fair enough. I don't know enough of your business, so if I go a little tangential to what you're building, please bear with me. But I would say the hardware or the software are not descriptions that investors would use, be it angel investors or VCs. This is not likely to be a part of the reference point by either elevating you or appreciating you because you're a hardware or software company or not. I think the 3 or 4 things that you might want to articulate in your pitch deck is considering that there are already so many robotics companies, large ones as well as small ones. What niche are you focusing on? That would be an important part to convey to investors. 2, what do you think are the upsides? Is it largely going to be sale of units? Is it largely going to be sale of royalty? Is it largely going to be anything to do with B2B2C or simply B2C and all those factors? So upsides of your business will have to be really, really well articulated. Third, investors would really want to hear from you what kind of moat are you building around your business? Can somebody else just throw a little bit of money or throw a little bit of time and build exactly what you have done? And if the answer is yeah, I mean, anybody can do it. I've actually sat through meetings where a founder actually gave this answer, yeah, anybody can do it. And the investors were like looking at each other and saying like, what am I doing here? If anybody can do it, then why should I be investing in you? So obviously, I'm presuming that in your case, it may not be the case of anybody can do it. There must be some very strong defensibles you have woven and baked into your business. So I would strongly recommend that you look at these 3 or 5 things in terms of arriving at evaluation. But I think hardware and software would be a trap and a milestone or a reference point you can easily and quickly abandon.
I mean, even understanding the investor profile also. How do we approach her? Because whenever we try to apply for some things, it looks like there is an 5x or 10x returns in a certain period of time. I mean, which is not true for a robotics company. I mean, that's what we understand from the business. But how should we be approaching the investors? I mean,
I would say for you to talk of returns at such an early stage, if you're an early stage company, would be too premature. What you'll have to look at is the drivers that are going to contribute to returns. For example, is there an IP that is so unique that there'll be people salivating simply because you have that IP, right? And that could get sold for $1 million or maybe multiple of millions of dollars. I'll give you a small example of 2 founders who had approached us long back. I won't share the name. This is a public forum. but very young founders, they believe they had a hack to improve the efficiency of lithium-ion batteries, where, as you know, from Stanford to Yale to IIT, there are, I think, 1,000 teams working on this project. But they were able to demonstrate that they have something, going for them, and the upside was in the form of a royalty. And maybe they had to start small because they had nothing to show. So it was a single-digit valuation that they had got, and they raised a couple of crores. But some 6 months back, I think longer, from the 7 or 8 crore valuation, they jumped to 198 CR valuation. They raised money, fairly significant chunk. Has a product come out today? Not necessarily. Have prototypes come out? Yes. Have those prototypes been deployed by some large organization like the really big names in batteries? Yes. So investors can smell the money. They can smell, they can sniff the trail. Okay, ठीक है, आज नहीं है. But fortunately, the investors are a very savvy lot. They don't start the conversation by saying, return कितना है. जो पुराने जमाने में गांव के साहूकार लोग होते थे ना, गाय बांध के रखो, फिर none of the investors, the savvy ones, and even the non-savvy ones for that matter, they don't ask this. The only place where you see that the investor is perhaps not so savvy is where he might ask you for metrics from the real world, from the listed companies. Like I remember sitting in a meeting and the investor was perhaps new to this domain, and after seeing the presentation, he says, "तो कितना PAT है आपका?" And the founder had not heard the PAT as a word for a long time. Maybe he had done BCom, so he knew it was in his syllabus. But उसके बाद उसका दूर-दूर से connection नहीं था PAT से. The only PAT he knew was the pat on the back, right? So that is the only mismatch. But otherwise, in fact, if you bump into investors who are too clueless about your business, hi बोल के चले आओ. Don't waste your time.
Okay.
Yeah. Next, anybody?
Thank you. We'll take question from Girish first, and then we'll move forward with Monsi and Kaushik.
Thank you so much. A wonderful, wonderful deliberation. There's a lot that I've learned. In fact, I've filled up about 4 pages of my book, taking notes. Thank you so much.
Thank you, Girish.
2 quick questions, sir. One is, in terms of a startup, our products are ready. We've got good margin. We've spent some time in building the business models, our pricing, promo, our IP, as well as the target audiences, well defined and well established now. We've got about 2,300% growth in terms of our revenue right now. But all this took about 7 years, including 2.5 years of COVID, where there was very little action. Because of which we are now not a young startup. And now that everything is in place, we need funds to scale up. So this is where we are caught up right now. We are not getting great amount of interest while everybody likes the business wherever we speak. But the only problem is taking it to the investment front is something that we're facing challenges. Any suggestions, sir, here?
So firstly, the 7-year story is not a disadvantage. It's not a cross around your neck. The only thing you might want to worry about is the 7 years will inch towards 10 years very soon.
Exactly.
And a lot of VCs have a mandate to invest in companies which are under 10 years old.
Correct.
So just be, mindful of that. I don't exactly know what domain or zone you are in, so my comments could be a little generic. You'll have to bear with me. But I don't see any of these points that you mentioned being liabilities or concerns. All of it are going to build up to a story where you have a fantastic story, a fantastic proposition. The only thing you might want to avoid as a pitfall, and I don't know whether you are having that issue, but sometimes founders tend to have that, is the number of years they have spent, the tenure, suddenly starts creeping into the valuation, and then there is a mismatch saying कि हमको तो इतना ही चाहिए, अभी 7 साल से हम कर रहे हैं, तो that. Now, if those things, largely from the founder's creation become a challenge, you might suddenly realize that your fundraising process is, horribly lengthened or elongated.
Got it.
Best thing to avoid. And I would say it sounds sometimes contrarian, but getting your first 1 or 2 investors should really be a function of how like-minded they are rather than the ask or the valuation.
Got it. Right.
If you have to compromise, and in fact, I won't even call it a compromise, but if you have to zero in on an investor who understands your space, could be a good asset. Now, doesn't mean he's going to come to your office every day. Doesn't mean he's going to give you 10 leads to dial every day, or will give you some कि अच्छा मेरे को यहाँ पे पहचान है. Don't count on that. But the fact that he's a good investor, good flaunt value, good acumen, good understanding. Ask and valuation can be secondary, because two things happen when you do that. You actually get a good name on your cap table.
Correct.
Two,
Right.
If there is an imaginary lock about fundraising not happening, वो टूट जाता है. The jinx gets broken, that that block gets overcome. So I don't know whether I did justice to your question, but I feel you're well set to kind of tackle the fundraise scenario.
Right. Sir, thank you so much, and it did help for sure. A continuation of the same question, and that's all that I will ask. There's some large deals that are round the corner for us, and we also have a large partnership brewing up, which is approaching the dotted line in probably a month or so. So as a company, I really don't know if I should wait for these things to happen so that my valuation goes up, especially considering the 7-year thing that I spoke to you about, or should we go in for funds right now so that the moment those deals and things happen, we are in a position to scale up even more?
Yeah, I don't think one should wait for the other.
Okay.
Because as with life, as with business, more the variables, more the delays, and more the anxieties and all of that.
Okay, got it.
So whatever happens first, just take it. If you get the valuation and the term sheet and everything sealed and signed up, and money is coming on your doorstep, you can always use the positive developments that are likely to sort of shape up for your next fund round. कहाँ भागे जा रहा है? Good accomplishment will always be used for the next fundraise. You're going to need ammunition all the time.
Right.
So if the fundraise happens first, and then you latch on to a really awesome deal or a big geographical expansion or some awesome partner or affiliate, even better. पहले चीज तो जो investors आएंगे वो तो तौबा खुश हो जाएंगे कि क्या founder है, मतलब they will put your photograph in next to their gods and all that. It was under promises and over delivers. If there was one thing I have seen across all investors, if I were to ask and say, what is one quality that investors will never disagree about? And you might say, this is saying the obvious, but I can tell you, I can vouch for it. I can write an affidavit on this. If the founder under promises and over delivers on the simplest of things, quarter ka performance ho, recruitment numbers ho, jo bhi ho, the founders are going to be loved by investors. So my 2 cents is, if the fundraise is happening first, please seal it right now. Best of luck, best wishes. And then whatever else happens after that is welcome.
Thank you so much, sir. Great clarity. Thanks a lot.
Pleasure. Thanks, Girish.
Here we take a question from Monsi. If you're on mute, you have to unmute yourself. Also, please do check the initiative of Mr. Sachin Karnik's co-founders. This is the greatunicornhunt.com. The website has been shared in the chat box. Monsi, over to you. Monsi, we are not able to hear you. I guess the audio is an issue.
He's still on mute.
No, he's not on mute, but audio seems an issue.
Audible now?
Yeah, you are audible.
I guess there's some problem with my headphones. Yeah. Hi, Sachin. Thank you for the great presentation. Very unfortunate I couldn't attend the whole part. I joined in quite late on the presentation. However, I have a quick question. My company name is Cluster of Computing. So just to give you a brief, we started 7 years back, and for the quite initial first 3 years, we were like developing mobile application. There was a concept idea which I took around to many of the unicorns and the investors, VCs across India. However, there was a chicken or egg situation that time, 2016-17, and people were not confident in investing on idea stage. But eventually, due to my previous contacts, and I was in touch with a lot of chemical process due to my history. So I was in touch with a lot of chemical and process industry. So we started developing a product which was into BI and analytics for chemical and process. So last 3 years, we have been actively developing product, and one particular client, it's a big group in India, and we have deployed across 4 to 6 plants. But again, this took us like 3 years, including the COVID period. But right now we are again reached a standstill point wherein others are in pipeline, and since the product is very advanced, not many other players are right now readily available to take it. So still the pipeline is very huge, and the conversion period is very high. Conversion window is very high for us. So I have a plan now to take the product onto the cloud and just split it up and have more customers. wherein the customers can access the tool directly on the cloud. Now, my question to you is, when I go to an investor again for this particular new concept, which we are almost developed and it's in prototype stage right now. So should I be doing this as a new company, founding a new company, or incorporating a new company, or should I be going, because I have this history of losses with my existing company, because first 7 years, though we have good product last track, I think we have done 5 to 6 active implementation. That's it for the last 3 years. So revenue wise, there's not a huge growth that I could show to them.
So my response to your question, Monsi, would be incorporating a new company is not the solution, because it's not as if you're going to be able to wish away the old company. There will be due diligence, there will be transparent disclosures where you will say, this is what I was doing in the other company. So from at least from the points you have shared, I do not see any merit in creating a new company, because there's nothing you will be able to strengthen or avoid or fortify by this mechanism. As regards losses, if you had a burn, people understand that, depending on which investors you're seeing for what kind of returns. But investors understand the fact that there was a development phase, there was the whole learning curve for you and for your clients to kind of absorb this new technology and deploy it and all of that. If there have been specific learning in terms of what took you so long and how you have mitigated it and how you have kind of started overcoming client objections, should certainly be strengthened and be very transparent about these were the deficiencies in the product earlier. It was not doing that. That's why the other takers were not kind of biting it. It is better to be transparent. It is better to celebrate what you have built, and in the same organization talk about a pitch deck and the narrative that kind of strengthens that all these 7 years has been an extremely foundational phase for your business, and that is how you are going to leverage every single learning from those last 3 or 5 or 7 years to present to the new set of investors. So there is enough money coming into India. There's enough investors in India who are getting activated. It's a question of you have to really find out who the right guys are, and I would recommend, if you've already done the selling, some large corporates as clients. Sometimes it is a less uphill sell to make the client an investor, and sometimes they may have the budget, sometimes they may have the policy, sometimes they may not have the policy. But no harm in exploring whether your existing clients, especially since you mentioned they are fairly big heavyweights, would want to somehow participate in the investment itself. I have had some examples where the company could not participate, but the MD, who was a majority owner, certainly liked what the company was doing and invested in his individual capacity. So it suddenly compresses your time to go to investors, and you get 2 or 3 very marquee investors on your cap table. It also gives you some breathing space to invest the next 3-4 months to go to new investors. So if you have a good story going, build on it. Please don't abandon it and try to wipe the slate now.
Sure. Thank you very much. I think it was a very valuable advice, and it could bring some clarity to my thought process. Thank you very much.
Thanks so much, Monsi.
Hello, sir. It was a wonderful session.
Hi, Kaushik. Please go ahead.
Am I audible?
Yes, you are audible. Loud, clear.
Yes, sir. Hi, sir. It was a wonderful session. So I'm Kaushik, and we are building a company called the Genie. It is a company that does food delivery, among a few other things connected to the merchants and the customers in ordering food online. So what we are essentially doing is not a product innovation, but a business model innovation. And we have spoken to 3 investors so far, and we have had like 2 rounds of discussion. One thing that makes it difficult for us to convince investors is that they are more looking into product innovation. Though we still do a bit of technology changes that which current companies do not adopt. How do you think we should go by with convincing investors about how to do it? We have a team of 12 on a sweaty equity, and our burn currently is not a lot. And plus, we have started signing merchants into the platform, and we see very little resistance there too. So if we approach 10 merchants on a day, we get 9 of them signed in on the same day. So on acquiring merchants, it's going great. So on building the product, on what we do currently, building our MVP, that is also going great. But on the investment front, we are still having trouble because investors are not excited by business model innovations as of today on the food delivery markets.
So again, with the limited information I have at my disposal, I may not be able to really comment, completely. But from what I have gathered, the likelihood, of investors having a concern that this could take a really huge, a ton of money to unsettle some of the current players could be a big worry. It's not as if they don't have a crore or a couple of crores or whatever you're raising to put in your business. They're going to worry that, what is going to happen if they are not able to raise funds after this. And I really have very limited information about your business, so it's not correct on my part to comment. But this is where you will have to perhaps take 2 or 3 approaches. One is to really look at the CAC, the customer acquisition cost. Start talking from the angle of how your model could actually feed into some of these larger players getting ready-made customer bases, if that's a part of your design. Or is there some way you can make the enemy your friend before you kill the enemy? So in the sense, are any of these big guys likely to appreciate your presence, even if it means you are a service provider initially, and it kind of at least gives you some amount of stable revenues? As long as the investor can see the fact that there is just this small curtain you have to pierce, and the moment you pierce, you're going to be out there like one of the next big unicorns in the country. That should do the trick. I know it is easier said than done. It doesn't happen simply by saying that, 3 months maybe we'll, pierce the curtain and show how big we are. But it is a combination of trying to work on all the factors that would be perceived as unique, number one. Number two, you'll have to be ready for a conversation with investors where he says, oh, this is a good innovation. What stops, I don't know, Zomato or Swiggy from doing this overnight? तुम तो 10 लोग काम कर रहे हैं. They will throw a team of 50 engineers on this product and crack it overnight, right? So what's the big deal about you doing what you are doing? Why is it such a earth-shattering thing? And I must tell you, very early in the game, take a call whether you are likely to be able to overtake or penetrate these guys, or you are likely to be a service provider. Because if you decide very soon that you're not going to be able to disturb these guys till you reach a lot of money, then the best thing you might want to do is get into a mode where you are totally centric or totally biased towards survival, building your business, your clientele, your geographies, whatever you want to build, and then obviously keep reaching out to more number of investors. In my mind, from whatever you have told me, it looks like the inflection point, the transition point between you staying a small company or developing or demonstrating that ability to do that big pole vault is the missing part. See if you can cross that hump.
Right. Thank you so much.
Thank you.
It was insightful.
Thank you.
Thank you. Thank you, sir. Before we take any more questions, I just want to highlight 2 important pages. This is Co-Founders Team. This is an initiative of Co-Founders Team, the Great Unicorn Hunt. Sir, would you like to highlight about how they can join this hunt?
Yeah, sure. So basically, it is a freemium portal. What it means is that there is no fee for startups to join the Great Unicorn Hunt. And I'll tell you where this, what was the idea or the genesis of this. Because I was president of a large angel investing network and then a CEO of a British company that was into crowd investing. One of the observations I had about the ecosystem is that it's fairly Brahmanical in nature. What I mean by that is, a lot of VCs, a lot of angel investors would take great pride in saying, oh, you know what, 6,000 startups apply to us. Oh, you know what, 20 get funded, 100 get shortlisted, 20 get funded. And my thought used to go out to the 5,980 guys who don't get funded. And, for most of the founders, it used to be like, oh, we send the decks, it just stays in the mailbox of the investors, doesn't even see the light of the day. So the Great Unicorn Hunt has been actually, created for every founder who believes he or she has the courage of conviction to become a unicorn someday. You can list on the Great Unicorn Hunt. You could drop an email to hello@the-great-unicorn-hunt, and if you need any assistance in uploading your deck or whatever, we will be able to kind of help you. That's not an issue. It's actually very self-intuitive. Just choose the founder role, co-founder role. You don't have to upload a deck. You have to just upload the image of the section. So highlight will just be that section, and Tam and Sam, and you have to just convert that your PowerPoint slide into a right JPEG or PNG image of the right pixel size and upload it. Obviously, please be mindful of the fact that your font size is good and all of that. That should not be like a reason why investors are not looking at your deck. But then, of course, like I said, the Great Unicorn Hunt has been created for that purpose. The plate is a little dated, but we have been fortunate enough, as you can see, from the VCs and the angels and super angels, that we have managed to attract a very, very marquee crowd of angel investors, corporates, incubators, accelerators, VCs. All of those, are there on the site. We are playing it very transparently. Most networks hide the people who are with them, saying, why should we tell them? Just go on our site and see if any of these people are relevant to you. Somebody was saying that, oh, you know what, but they will go directly and have their deals done directly with the VCs. So I say, because of our site, if those 20 people who get invested are going to get invested, no harm, absolutely no harm. This is a freemium model. So we would absolutely welcome anybody and everybody who would want to join the Great Unicorn. Investors, have placed their faith and capital with us. We have raised money at a 21 crore pre-money while we were in the pre-revenue mode, pre-stealth mode. So touch wood, the validation for us has come in some shape and form, but you're all cordially invited to join the Great Unicorn Hunt.
Thank you, sir. And a little bit about us, as we the host of this masterclass, the Aegis Scramble Awards. I'm the curator of this award, and this is one of the largest innovations award, which has been supported by the government, and we are inviting innovations as well. If you have innovations to showcase in any of the categories which you wish to highlight, you please do submit your innovations. This is an largest innovations award where the country competes, and we look forward for your innovations. The details are on the contact, or you can go on the live chats to connect with any of your assistants in terms of your submissions. The details are highlighted here. In terms of your submission, you can contact our leads. Over to you, sir. Professor, if you're there on the call. Yes, sir. Sir, if you could turn on your video. Yes, thank you.
Sachin ji, good evening. It was such a wonderful session. And thank you so much for accepting our invitation to share your valuable knowledge. And I was hearing conversation, these budding entrepreneurs, they were asking questions, and really you brought in some level of clarity to all of us. Thank you so much to you.
Thank you so much, Bhupesh. Thank you for inviting me. It is always a pleasure to be a part of the budding entrepreneurs conversation and hear about the various challenges and success stories. So I must thank you for giving me the opportunity to interacting with this talented lot. And thanks, Gavin, and thanks to the entire team at Aegis for putting this fantastic session. And people keep telling me that there are a lot of events such happen, and what's one more, and why do we need? And I think the events that you do, including the one that you just did, is a testimony of the fact that there will never be an upper limit on ideas that can be exchanged and knowledge that can be shared and thoughts that can be percolated. So awesome initiative. Thank you so much, Bhupesh. Thank you so much to the entire team.
And one other good aspect is when people ask questions, that actually crowdsource to the knowledge, because not necessarily that we have the ready answers for most of the questions. Asking questions is the art.
Absolutely.
Thank you so much. Thank you so much, everybody.
Thank you for joining for this masterclass. We intend to do more masterclass like this, and I'm going to be collaborating with co-founders as well. In case you wish to view the website, please do view the website. Let's mention in the chat box. If you wish to connect with Mr. Sachin, he's on LinkedIn. Please do connect him on LinkedIn to ask any questions if you wish to. So if with your permission.
Sure. Most welcome.
Sure. And we are intent to do more masterclass like this, 26th of September. If you wish to write back to us, asking us what is the topic, we would like to crowdsource a topic with you in terms of the topics. If you wish to have certain startup as their journey of investment, wish to have certain investor as a lead, let us know. We are open to hear the topics and help you the best what we can do for the startup community. Thank you for joining.
Thank you so much once again. Good day. Best wishes.
Thank you.
Okay. Bye-bye, Sachin ji.